Real estate versus the stock market. Which is better to invest in? Well, it depends upon a few factors, and we're going to go over those factors in today's video so that you, as an investor, can understand how either might best fit into your financial plan. Hey everybody, I'm James Knoll, founder of Root Financial Partners, and I'm here to teach you what you need to know to create a secure retirement. So how do we compare what's better? Is it better to invest in real estate or is it better to invest in the stock market? And by the way, when I'm talking about investing in real estate, I'm not talking about owning a REIT or maybe a mutual fund that invests in real estate companies. I'm talking about physically owning a rental property. So what's better between the two? We're going to talk about the trade-offs and how do you analyze this for your specific situation. But to start, I want to talk to you about how do you not run this analysis. This was a recent video I saw from a real estate expert talking about the benefits of real estate investing and why it's so much better than the stock market. He used an example that went something like this. Let's assume that you have $100,000. You can choose to invest that in the stock market or you can choose to invest that in real estate. Well, let's assume that both the stock market and real estate grow by 8% this year. Well, if you invest that $100,000 in the stock market, your $100,000 turns into $108,000. It's pretty simple. Well, if you invest that $100,000 into real estate, you're typically not going to go buy a home for that full $100,000 in cash. Typically, you're going to put a down payment on the home and then borrow the rest. So that $100,000, that could represent a 20% down payment on a $500,000 home. So in this example, if you put $100,000 down, you borrow the remaining $400,000, that's the mortgage, and then you have an asset worth $500,000. Well, if that asset grows by 8%, that asset has increased from $500,000 to $540,000. So for you, and this is the example they give, they said that's a 40% return for you because you put in $100,000 and the asset grew by $40,000. So if you divide the growth, $40,000, by the amount of capital you put in, $100,000, it looks like you had a 40% rate of return. And everyone looks at them and they say, oh my goodness, this is the best thing ever. Why would we ever own investments in the stock market versus real estate? Well, that's the wrong way of looking at it. And I'm not to say that you shouldn't own investments in real estate or you shouldn't invest in real estate, but we're going to walk through a better way of looking at that. Because although that example makes sense on paper, what it doesn't account for is it doesn't account for the cost of capital. It doesn't account for the cost of maintaining that asset. So for example, if you buy a $500,000 home, you have to back out property taxes, which is an expense that you're paying to maintain that asset. On a $500,000 home, that might be $5,000 to $6,000 per year. If you have a mortgage, the bank's going to want to collect interest on that mortgage. So again, in this example, that $400,000 mortgage, if you assume a 30-year mortgage at a 3.5% interest rate, the monthly mortgage payment is about $1,800, which is around $21,600 per year. Now, some of that mortgage is increasing your equity because it's paying down the principal. But most of that mortgage, especially in the first few years of the loan, is just going to pay interest. And in fact, that first year of interest payments, 64% of the mortgage payments you make, 64% of it goes to interest. So that's almost $14,000 right there. So once you back out the property taxes, once you back out the interest rate, so the cost of capital in order to do this, once you back out maintenance costs, the cost to close on the loan, the cost of everything else, all those need to come out of the calculation to see what is the rate of return after that. Because leverage is going to amplify the return because you're using borrowed money to get more return, but leverage also creates additional costs, so you have to factor that in. Now, the opposite is also true with leverage. So that's an example of how, yes, leverage can be helpful with real estate. It certainly is helpful with real estate when things are going well. If any return that you're getting, it is amplified by that loan that you have. But here's what happens in the opposite scenario. Let's go back to that example of having $100,000. Well, if I put that $100,000 in the stock market, let's assume we have a bear market, which is defined by the stock market losing 20% of its value. Well, that $100,000 turns to $80,000. So not a fun experience. $100,000 turns to $80,000. With real estate, let's assume the same example. I once again put $100,000 in. That represents a 20% down payment on a $500,000 home. If that $500,000 home immediately were to lose 20% of its value, well, the 500 turns to 400. So you have an asset now worth $400,000. You also still own the bank or still owe the bank $400,000. your equity is zero before even backing out the cost of capital, the cost of property taxes, the cost of everything else that would actually lead to a negative return in that year. Now, these are just two hypothetical examples, but what it shows is it shows how leverage can drastically change the return you can expect on things. And as long as things are going up, leverage on the real estate side really helps to amplify it, but keep in mind there is a risk to that as well. So as we're looking at this, how do we compare the two of these? Is it a simple apples to apples comparison of investing in the stock market versus invested in real estate? It's not. So here's the trade-offs that we want to make sure we're examining. And before we really jump into these trade-offs, I want to make it clear that typically financial advisors, not all of them, but a lot will just say, don't invest in real estate, just invest in stocks. Typically real estate people, whether it's real estate agents, real estate investors, will say, don't even touch the stock market, just invest in real estate. Well, they're both wrong. Really, this comes down to what's best for your specific situation. Both can be amazing places to invest your money, but we have to understand how both work and we have to understand the trade-offs involved with each. So number one, as we walk through what makes more sense, the first thing we want to look at is how do you account for the total return? Well, in the stock market, it's pretty easy. What was the appreciation you received on your investment, plus any dividends or interest that you received? Say I buy a stock and it goes up in value by 8%, and that stock also pays me a dividend of 2%. Well, 8 plus 2 is 10%. I got a 10% return. It's pretty straightforward there. Well, with real estate, it's not as straightforward. You have what's called the cash on cash return, which is just what cash flow are you getting for buying a piece of property and turning it into rental income. So let's assume that you buy a home for $500,000. Let's assume that you have $25,000 per year that's coming in rental income. The first component of the return that I want to understand is what does that represent in terms of just a cash flow or a cash on cash return? Well, $25,000, which is the income that I'm getting, divided by $500,000, which is the asset value of the home, that's 5%. So I'm getting a 5% cash on cash return for my property. That's step number one, at least how we're looking at it. The second piece is how much is that property going to appreciate in value? Now, we're living in times now where the last few years, real estate values have skyrocketed, especially in certain pockets of the country. Is that sustainable? No, it's not sustainable forever. A lot of places have increased in value 20 to 25% in the last year. That's not going to happen forever. Historically, if you look at nationwide in the US, real estate prices have gone up by about 4% or so per year. So that's been what's been average historically if you look at the country as a whole. So if we look at that, let's assume we get a 4% increase in our real estate value. So we have a 5% cash on cash return, just income from the property, plus the 4% appreciation. So far we're up to 9%. Now, we talked about the concept of leverage. If you are buying a property using leverage, which most people are doing, most people aren't buying the whole property in cash, but if you're using leverage, that return is amplified because you're putting fewer dollars down to still get the full appreciation on the full value of the asset. So that $500,000 home example, if that increases in value 5%, you actually get a better than 5% rate of return on the money you put down because you're not putting the full $500,000 down. So you have to factor in leverage, and whether you're financing 20% of the home or 50% or 5%, that's going to change this. So you're going to have to run your own modeling and your own projections, but keep in mind that leverage can amplify that. It can also detract from that if property values aren't going up. Then you have to back out things like the cost of capital, you have to back out the cost of maintenance. What is it costing to maintain this asset? If you have a property that's generating $25,000 per year in income, but it's costing $25,000 per year to maintain, between the cost of maintenance, between say HOA fees, between mortgage interest, between property taxes, well, technically that washes out a lot of the return on the income side. It's just appreciation from that point on that you can count on. So that is how you look at real estate. And then there's also the benefits of depreciation. Depreciation is kind of like a phantom expense. So when you own an asset, you're allowed to depreciate, which is a tax benefit, and that is a write-off against the income that you're receiving from real estate. So while you're looking at this is step number one into understanding, is real estate a better investment for you or is stock investing a better investment for you? But the first thing that you have to understand is what's the return that you can expect from each. Now let's say you have that calculation done. You're not done yet. It's not as simple as saying which number is higher. There's other considerations that you have to keep in mind. The first is how involved do you want to be? If you own a stock, if you own a fund, there's zero involvement on your part. Let's say you go buy stock in Apple. You're not going to be expected to attend Apple meetings. You're not going to be expected to train the next round of people who are coming on board at Apple. You're not going to be expected to be involved in any way, shape, or form when you buy a stock. There's literally zero involvement on your part. With real estate, there is a lot of involvement. Everything from getting tenants, everything from managing the property, from doing repairs to paying taxes. There are things that you need to do to be involved with on the real estate side. It's not a good thing or bad thing. Some people love that. Other people hate that. Just understand that's part of what goes along with this. Now, you could get a property manager, and that property manager could absolutely take care of a lot of these things for you, but then you have to go back to step number one and back out their cost from the total return that you can expect from your property. So if you're paying a property manager, they're going to take some percentage of the income you're charging. You have to back that out of your example when you're calculating what's the return that you can expect from this asset. But really be aware of how involved do you want to be. The next consideration is liquidity. If I own a stock investment, and when I say stock investment, this could be an individual stock, it could be a mutual fund, it could be, it doesn't matter. Just are you owning some type of financial capital investment or some financial investment? Let's just use a mutual fund, for example. It's fully liquid. Now, I'm assuming I'm doing this outside of an IRA or a 401k because we're comparing this to owning real estate. So both would be done in non-retirement accounts. It's fully liquid. Now, that stock's going to increase and decrease in value. So there's no guarantee if I put $100,000 in, it'll be worth at least $100,000 when I pull it out. There's no guarantee of that. But it is a fully liquid investment that I could turn around and draw from anytime I needed. With real estate, it's not going to be a liquid investment. If you want to access the equity or the capital inside of your asset, you either need to sell your property, which is going to incur additional costs. It could incur taxes. There could be some other things involved, or you would need to refinance your property to take cash out of it. So it's not liquid in the sense that with a stock, you can go access that money whenever. With real estate, you can't necessarily do that. Again, this is not a good thing or bad thing. It's just the reality of it. So as you're looking at what's best for you, ask yourself, to what extent do you need liquidity? With real estate, you should be getting some income each month. And so hopefully that income is covering all the costs of the property and then some. So there's some cash coming from it, but it's not fully liquid. You need to ask yourself, do you need this for any particular purpose? If you are investing because you want to send kids to college and college is coming up in 2 years, do you want that money tied up in real estate, or do you want that money liquid where you can access it, as an example? Now, if this is long-term money and you say, I couldn't care less about liquidity, I want to build equity and I want to keep this asset growing, maybe not as big of a concern for you, but you do need to make sure you have liquidity somewhere else just in case. If you look at 2008, for example, a lot of people who were heavily invested into real estate really lost a lot of money. Now, it wasn't because of the real estate necessarily that they lost a lot of money. It was because there wasn't liquidity to compensate for all that real estate that they had. If you can keep paying your mortgage, if you can maintain the property, you're not going to go under, you're not going to lose your home. It's really if you have something that's over leveraged and you can no longer afford it, and you don't have equity or you don't have liquidity from somewhere else to pay for it, that's where you run the risk. Because let's say, going back to that example, you put 20% down on a home. Well, let's assume there's a major mortgage or there's a major housing crisis next year and housing prices lose 30% of their value. Well, your $500,000 asset, all of a sudden that turns into a $350,000 asset. Well, if you borrowed $400,000 from the bank to pay for that, you can't just sell your home to get out of it because you would still owe the bank $50,000. Even if you were to sell it and pay the mortgage back, there's not enough equity in the home to pay the full mortgage balance. So you do need to be sure, do you have liquidity in other places if you're going to implement a real estate investing strategy in order to be able to pay the bank and to maintain that property, which can be a great long-term investment, but it does have a cost associated with it. So that's one thing to be very mindful of, is the liquidity or the lack of liquidity with real estate. Another factor is just the risk component. If you're going to have rental real estate, there's oftentimes going to be a second mortgage that you're paying for. So maybe you have your primary home that has a mortgage. Maybe that real estate property has a mortgage. Maybe you have multiple properties that all have mortgages. Now, as long as some of those real estate properties are rented out, that mortgage probably isn't too big of an issue for you. You have cash flow coming in to pay for that mortgage. you do have to be aware of the risks. We saw this a lot in COVID, where COVID happened and there was just laws that went into play that some people could not legally collect rents. Now those people still had mortgages that they had to pay, but if you can't collect rent and you can't pay the mortgage, you're going to be in a really difficult position if you don't have that liquidity to pay for it. So just understand there is another degree of risk that comes along with real estate, of it's one asset and that asset requires capital to be maintained. So you need to make sure that you can maintain that to be able to go through the ups and downs and to be able to withstand some of the risk when it comes to your way. So there is an extra layer of risk. Be careful with that. It's not saying don't do it, it's just make sure that you have a plan to account for that so that you don't get in any sticky situations with regards to maintaining that real estate property. The next piece I would look at is your desire for simplicity. Real estate's great, and a lot of people, it's kind of part of the American dream. I want to own properties. It's tangible. I can touch it. I like seeing that I have this asset. It can be a wonderful thing. It does not necessarily add simplicity to your life. So ask yourself, how much is simplicity important to you? And simplicity in the terms of, or from the standpoint of, you don't have to worry about what's going on. You don't have to maintain a property. You don't have to be there to pay property taxes or repair a roof or to call the handyman or to answer phone calls late at night. How much simplicity do you desire? Again, with stock investing, yes, it can be scary. Yes, there's ups and downs, but that's kind of the extent of it. With real estate, there are ups and downs. It doesn't seem as much because you don't see the value of homes changing every single day like you do if you look at CNBC or your stocks app on your iPhone. That changes in value, but the real thing is, how involved do you need to be? How complex is this making your life? For some people, it doesn't matter to them. They like having their hands and they like being involved with it. For other people, if their desire is just for simplicity and I want to retire and I want a paycheck and I want to be able to travel the world and do whatever I want, real estate could make sense for that if you have a property manager or wonderful tenants or things really set up the right way, but it could also backfire. And there's a lot of people that have had miserable experience with tenants, or things have been trashed or things haven't been maintained. And there's no way of knowing up front what you're going to get, but just understand there's typically another element of complexity involved when you are owning rental real estate. So with all that being said, the question is, which is better? Well, here's the lens that I like to view it through. I like to start with, what's the total return of each? The long-term historical return of the S&P 500 has been about 10% per year. The long-term return of the Russell 2000, which is small companies in the US, is about 12% per year. Why does that matter? To me, I almost like to use that as a threshold, almost like a minimum amount required. If I'm looking at the return on real estate, and even after accounting for things like leverage, but then backing out the costs involved and understanding what's my cash return, what's the appreciation I can expect, if that number isn't higher than 10 to 12%, to me at least, I'm looking at that and saying, why on earth would I do that? Why on earth would I do that when I could get something that's going to grow by that amount, or at least historically has grown by that amount, with 0% of my effort, 0% of my time, 0% of my energy? All I need to do is simply allocate that money there and let it ride. So for me, that's kind of the threshold that I want to cross, where if the return on real estate is equal to or less than that, this isn't a recommendation, of course, this isn't the way everyone looks at it, but I look at that as, why would I take on that extra risk, that extra time, that extra energy, when I could just do something more simple like stock investing? However, if I'm running the numbers and real estate starts coming in at 14%, 15%, 16%, whatever it is or higher, that's where you have to make the trade-off of, am I willing to take on what could be a little bit more risky, what could require more of my time, more of my effort, but I'm willing to do so because it has a higher return premium. That's the instance in which it might make most sense. At the end of the day, both stock investing and real estate investing can be wonderful investments for you. Don't let anyone tell you one is the only way to go. Really, they both could be the way to go, but it takes some due diligence on your front. Now, at the end of the day, what it comes back to is, what's going to help me, or what's going to put me in the best position to retire and meet those goals one day. If you would like more information about that, check out this video here so you can start to see how either of these investments might best fit into your investment portfolio. Thanks again for watching. This is James Canal with the Root Financial Partners. If you enjoyed this video, please be sure to share it with someone else who you think could find value from it. And also be sure to like this video and subscribe for more content like this. And if you want more resources about how you can create a secure retirement, be sure to check out our podcast called Ready for Retirement. And finally, if you're interested in seeing how our services can help you create a secure retirement, check us out at rootfinancialpartners.com.